Welcome to this lecture on Henry George's views on money, banking, and credit. I'm Edward Dodson. Over the centuries, there have been many views expressed on the origin, evolution, and forms of money established by societies with very different systems of socio-political arrangements and institutions. Extensive analyses are provided in the writings of the great and less great political economists during the 17th, 18th, and 19th centuries. As the 19th century was coming to a close, the American journalist, author, and self-taught political economist Henry George examined the writings of his predecessors and contemporaries, reaching very important conclusions regarding how money creation, banking, and credit fit in with what he argued were natural laws affecting the production and distribution of wealth. My own study of the subject began as a high school student, further stimulated by courses taken as a college student, and several years thereafter during a year of study at the Philadelphia extension of the Henry George School of Social Science. During that year, I read and discussed with others the major works of Henry George. George had himself devoted years of studying the great works of his predecessors and contemporaries, thoughtfully evaluating the extent to which their writings met a rigorous test of objective analysis and accurate representation of how human beings interact with one another, with nature, and with societal institutions. George offered his own observations and conclusions regarding money, banking, and credit that remain useful today. In his first major writing project titled Our Land and Land Policy, George rightly criticized how the government of the United States was treating the nation's most important asset. He wrote, "A generation hence, our children will look with astonishment at the recklessness with which the public domain has been squandered, for certainly our whole land policy seems to have been dictated by the desires to get rid of our lands as fast as possible. The government has made nothing to speak of from its lands, for the receipts from sales have been not much more than sufficient to pay the cost of acquisition or extinguishment of Indian title and the expenses of surveying and of the land office." A few years later, he set out to write what he described as, quote, "an inquiry into the cause of industrial depressions and of increase of want without increase of wealth," the book eventually titled Progress and Poverty. George spent almost no time discussing the origin of money or the role of the banking sector in this work, however. What he took pains to clarifying was what he was referring to when he used the term interest, a term we commonly attach to money, banking, and credit. Interest, as an abstract term in the distribution of wealth, differs in meaning from the word as commonly used in this, that it includes all returns for the use of capital and not merely those that pass from borrower to lender, and that it excludes compensation for risk, which forms so great a part of what is commonly called interest. At this stage of his career, George was lecturing frequently and writing articles for newspapers and magazines. In 1883, a collection of these articles was published in book form with the title Social Problems. Here he expressed his views on money creation as an important function of government. "It is the business of government to issue money. This is perceived as soon as the great labor-saving invention of money supplants barter. To leave it to everyone who chose to do so to issue money would be to entail general inconvenience and loss, to offer many temptations to roguery, and to put the poorer classes of society at a great disadvantage." These obvious considerations have everywhere, as society became well organized, led to the recognition of the coinage of money as an exclusive function of government. When in the progress of society a further labor-saving improvement becomes possible by the substitution of paper for the precious metals as the material for money, the reasons why the issuance of this money should be made a government function become still stronger. The evils entailed by wildcat banking in the United States are too well remembered to need reference. George goes on to explain that permitting banks authority to issue money is inherently corrupting of government, while also imposing heavy financial costs on the general public. Opposing all forms of monopoly privilege, George became a staunch defender of the freedom to engage in commerce without restriction, so long as government oversight assured what he called, quote, a fair field with no favors. This became the subject of his next major work, Protection or Free Trade, published in 1886. George asked readers to consider the absurdity of the general belief that a nation prospers by producing for export a higher value of goods than are taken in as imported goods. What is accumulated by a trade surplus is money, not tangible wealth. In his words, it is to confusions of thought growing out of this use of money that we may trace the belief that a nation profits by exporting and loses by importing, a belief to which countless lives and incalculable wealth have been sacrificed in bloody wars, and which today molds the policy of nearly all civilized nations and interposes artificial barriers to the commerce of the world. George urged readers to see that conditions of exchange had changed over time and were changing even more rapidly with the introduction of new communication and transportation technologies. The need to hold on to precious metals to offset all manner of risk was, he argued, far less important than even in the recent past. Moreover, the interferences in commerce designed to increase a nation's stocks of precious metals is counterproductive. All efforts artificially to increase the gold and silver of a country have had no result save to hamper industry and to make the country that engaged in them poorer instead of richer. At heart, George was a journalist, and he believed in the power of the press to influence how people thought about important public issues. So in 1887, he founded The Standard, in which he wrote editorials on many subjects, including matters relating to money, banking, and credit. In the paper's 11 February 1888 issue, he argued against the use of government to enforce the collection of private debts and floated the idea of a public debt jubilee. The abolition of all laws for the collection of private debts would not only free our judicial machinery from a clogging mass of business which to a large degree prevents its performance of proper functions, but it would unquestionably lead to a far higher standard of personal and commercial morality, since character would then be the prime element in credit. He then provides insight into the operation of credit markets that 2 decades later would serve to establish a primary mitigating function of central banks, and the Federal Reserve Banks of the United States in particular. The curse of credit as a flux of exchange is that it expands where there is a tendency to speculation and sharply contracts just when most needed to assure confidence and prevent industrial waste. He asks readers to consider why government spends more than is taken in as revenue from taxation and other sources. Wars, he reminds them, are paid for by borrowing from those who have financial reserves so as to avoid, quote, exciting their opposition. Public debt is justified, quote, only so far as there are public improvements to show for them. Finally, he addresses the waste associated with minting of precious metals into coinage. Why not leave the silver in the ore and the ore in the ground? That would be a far greater economy. As for the silver notes, that would be just as useful and just as readily taken if they promised to pay silver yet to be mined and refined, or if instead of promising to pay anything at all, they were simply made receivable for public dues. Although George argued the case for government money, he opposed creation of a national banking system. In the 28 April 1888 issue of The Standard, he explained his reasons. The national banknotes current in the United States fulfill the functions of generally accepted money, not because they have the name of a bank printed on them, not because bonds are deposited for their redemption, but because they are issued by the general government, bear its stamp, and rest upon its credit. They are in no wise better than the notes directly issued by the government, but derive their security and usefulness from the same source that gives the greenback its security and usefulness: the fact that they are issued by the government and are receivable for its dues. The proper business of banking is the receiving, the keeping, and the loaning out of money, and the facilitation of exchanges by the extension, interchange, and cancellation of private credits. With the issuance of money, the proper business of banking has nothing whatever to do. A meeting between leaders of the Knights of Labor and Farmers Alliance took place in St. Louis late in 1889 to discuss issues of mutual concern. One of the issues related to the free and unlimited coinage of silver. George offered a warning. What does the free and unlimited coinage of silver mean? It means simply that the government mints shall impress on any amount of silver which anyone may bring them for the purposes that official stamp or fiat, which now enables 72 cents worth of silver or its representative to pass current among our people for $1. So far as this stamp or fiat would add any value to the silver, its effect would be to enable the owners of silver mines, the banks, and the owners of silver in foreign countries to make forced sales of silver to the masses of our people at more than its market price. But the speedy and inevitable result would be the depreciation of our currency and the driving out of circulation of everything but silver and silver notes. A few weeks later, George responded to a reader's desire for him to be more specific in his position on the use of silver as money. To this subscriber, he wrote, "What I object to is that the people of the United States should be taxed to buy silver and coin dollars for which they have no use, and that the nation, the far greater part of whose component individuals needs more capital, should keep great hoards of coined bullion lying in treasury vaults, where it is utterly useless to anybody." He went on to explain to his readers that the coinage of whatever metal is convenient for only a small percentage of the exchanges occurring between parties. Their use is both costly and inefficient. The induction is irresistible that it is not the intrinsic value of the money, anything that is pledged for the redemption of the money, or is held by the United States as its representative, but the credit of the government itself, which secures the common consent by virtue of which our money circulates. One uniform currency consisting of paper and subsidiary coins, the direct issue of the government, and such gold coin as anybody wanted the United States to assay and stamp, would save an enormous sum annually to the people of the United States. George returned to the subject of money and the coinage of silver in a tract published in the Sterling Weekly dated 1 August 1896. He repeated his earlier observations and wrote briefly on the greenbacks spent into circulation by the government during the Civil War. The virtues of the greenbacks were, to George, obvious. Greenbackism was, in original and rational form, the recognition of the fact that this money needed no backing of deposited bonds or gold reserves, and was the cheapest and fairest form of money, giving to the greater part of the country what it had never had before, a uniform and convenient medium of exchange, and utilizing for the benefit of the whole people the enormous economies effected by the substitution of paper for the precious metals. It was a protest against the manner in which, during exigencies imposed by the war, the finances of the government were used for the special benefit of the moneyed class, against the repudiation of its own money by the government in making duties collectible and interest payable only in gold, against the institution of the national banks, a device by which the government was made to pay interest on money it loaned, against the assumption that a great volume of the debt for which no stipulation of payment in gold had been made was redeemable only in gold, and against a forced contraction of the currency which worked hardship to debtors and serious injury to businesses. By this time, he had been working to finish the manuscript that would be posthumously published in 1898 as The Science of Political Economy. The final part of the book he devoted to the subject of money. His analysis was already firmly established, so he broke no new ground. Only by grasping the full context of the analysis he presented in the book would the role of money become clear. Unless we have clear ideas of the meaning of value and the nature of wealth, it is manifest, therefore, that we cannot form clear ideas as to the nature and functions of money. Henry George's analysis continues to resonate even today as we rely extensively on digital records of money balances held on our behalf by one type of financial institution or another. Only a small number of countries operate without a central bank to manage the supply of money and the price of borrowed funds. The direct government issuance of money advocated by Henry George is absent from the nations generally thought of as social democracies. Russia's central bank is owned by the state. China's central bank is ostensibly autonomous but is subject to close government oversight. As I have discussed in a course on the history of money, banking, and credit, the global monetary system has suffered numerous periods of instability and near collapse, triggering a wide variety of proposals for systemic reform. What follows are some thoughts I offer for consideration and discussion in response to the problems as I see them. I have thought long and hard about what Adam Smith wrote about the virtues of the system of receipt money issued by the Bank of Amsterdam during the early 1700s. Could this type of bank provide stability to the modern monetary system? Henry George did not really discuss this issue. Thus, what follows is the case for establishing an international system of deposit banks creating a coinage of a standard weight and measure of gold and or silver. This coinage would serve as a base monetary unit consistent across participating countries. What would this system look like and how would it be created? History tells us that over time what people most trust as a storehouse of value is gold and silver. There are strong reasons for this, of course. These metals are nearly indestructible. The demand is universally strong and the supply relatively stable. However, receipt money could be backed by other tangible goods. One possibility is construction bricks, which have nearly all of the advantages of precious metals and none of the disadvantages. They are easily produced with minimal environmental damage. They do not need to be stored in expensive facilities under armed guard. They last for hundreds of years, and there is a constant and universal demand for them in the construction of all manner of buildings. Many countries have a long history of minting gold and silver coinage. To collectors of rare coins, they often command a price far in excess of the current market value of the precious metal out of which they are minted. Governments, in effect, sell money at a profit in order to raise, quote, legal tender to pay for public goods and services. This collector's market for rare and limited pressed coins would certainly continue to exist. Here are the gold reserves held by the top 10 countries. The United States with over 8,000 tons. The mines of Peru, Australia, and Poland produce the largest annual additions to the quantity of silver mined, followed by Chile, China, Mexico, the United States, Bolivia, and Russia. Ideally, representatives from the countries that either hold existing reserves or control in-ground reserves would sign a treaty agreeing to monetize some portion of their holdings of gold or silver, minting coinage according to universal standards of metallic content. The coins would be held by publicly owned deposit banks as full backing for a new form of receipt currency or its digital equivalent. Thus, the value of the receipt currency would be uniform throughout the world. Holders of any form of fiat currency now circulating could exchange these currency balances at whatever exchange rate the market determines, subject to agreed upon levels of expansion and the supply of new coinage each year sufficient to meet the need for credit in the global economy. Private individuals, business entities, and other organizations would become members of the deposit bank by purchasing gold and silver in the open market to be minted into coinage and then deposited with one or more deposit banks based on their commercial interests and needs. Members would then be able to buy and sell goods or services with other members with automatic debits and credits recorded. Bad debt expenses would essentially disappear. Existing commercial, savings, and investment banks would become a member in the same way, thereby establishing an account balance against which they can make loans to third parties at interest based on risk and the opportunity cost associated with a temporary transfer of purchasing power. Of course, lenders could suffer losses if those to whom credit is extended fail to repay what is owed. This is but a rough presentation of how such a system of deposit banks issuing receipt money might be introduced today. A version of the monetary law put forward by Thomas Gresham is anticipated in reverse. Fully backed receipt currency and bank balances will drive out fiat currency and fiat currency bank balances over some period of time. This process will need to be efficiently managed during a period of transition and retirement of circulating currencies. A new Bretton Woods conference would be needed to work out the details. And with that, I end my lecture on Henry George's views on money, banking, and credit, and I hope you found this of some interest. Thank you.